Please welcome the panel on Systems Finance for Sustainable Development, moderated by Executive Director of the Syngenta Foundation for Sustainable Agriculture, Simon Winter.
Thank you. Welcome, everybody. This session is a follow-on to a session that we had, I think, in this room, if I remember correctly, a year ago, where we started to talk about how to have a more integrated approach to deploying finance into the fields of smallholder farmers in developing countries who are facing some of the most extreme changes in weather volatility, reductions in water accessibility, degradation in their soils, and so on. And there's been a lot of work done over the last 12 months to get us to this point, where we're now having a panel to talk about all the different components of what it takes to unlock flows of finance to support farmers, not only in developing countries, but particularly from our focus at Syngenta Foundation into developing countries. If we can go to slide 2, we are in the process of formulating a smallholder action coalition on climate adaptation. And Secretary Vilsack in the previous remarks mentioned the Aim for Climate sprints. We're one of those 50 sprints that he was talking about, supporting the coalition. And what we're trying to do is really take as the theme for this session describes, a systemic view, because what we've seen over too long, and particularly in the face of climate change, is there's too much siloed activity. There are innovators trying to deploy innovations, but without the capacity building support, the technical advisory. You have financiers looking to do deals, but they don't have access to the innovations. And the farmers at the end of the day in underserved communities are still often outside the market system, even for, let's say, normal agricultural advancement, let alone now having to deal with the climate challenges. So the coalition really has three main objectives. One is to identify and then deploy those innovations, whether they're coming from public sector organizations like the CGIAR or the land-grant universities that we heard about, again from Secretary Vilsack in the United States, or coming from local entrepreneurs or even American entrepreneurs who are developing agricultural technologies. Making sure that they can be used by smallholder farmers through local entrepreneurial networks, strengthening market systems by boosting rural entrepreneurship. There's a lot of echoes you'll hear as I'm talking about this of what Secretary Vilsack was talking about in terms of what's happening in the United States, and we're seeing exactly the same needs in terms of supporting historically disadvantaged and underserved farmers in emerging markets. And then finally, putting together all the financing pieces that can come together through more coordinated structures. So if we go to the next slide, you'll see that the way we're framing the coalition is really on three main pillars. One is around what are those innovations that are most needed to help the farmers address the climate challenges? How do we get the delivery mechanisms working through local entrepreneurial networks? And then how do we deploy the finance? Next slide, please. And all of this comes together for us in what does good look like as a first-to-market opportunity? And we're in co-creation mode now with BRAC, the very large international nonprofit that is particularly dominant and prominent in Bangladesh, to put together a program that would support 1 million smallholder farmers in Bangladesh in two vulnerable landscapes, one that's saline-prone, one that's drought-prone, to transition their farming not just to low methane and higher productivity farming, as we heard with the CSA example that Secretary Vilsack talked about in the United States, but also to diversify their farms so that they can access higher quality markets for higher value products and improve their incomes, but at the same time improve their resilience in the process. This is in the pipeline now for a major Green Climate Fund award that, if all goes well, would be approved by the Green Climate Fund in early 2025. And it's based on, the next slide please, it's based on a transition of the rice production, very much again in line with what Secretary Vilsack was talking about. But what's critically important is we don't just do this at a small pilot scale. We've actually already proven this with about 10,000 farmers with work that was supported by the International Water Resources Group and Coca-Cola Foundation over the last few years, that there's a business case for the farmers to make this transition. There's there's a business case for input suppliers, off-takers, and financiers. But now we need to go to scale. And the scale doesn't stop, by the way, with 1 million farmers. That would just be the first phase of what we think could be at least a 5 million farmer transition, mobilizing eventually around $1 billion of finance into supporting that transition. And then finally, this all comes together from our perspective in terms of the systems coordination. So we hear a lot about blended finance, and there's an illustration on the slide about how does the stack of capital that's required at the individual farm level look. And we're talking about very, very small amounts of money to support each of the elements. But it's the coordination then of all of that we're going to hear a lot about, I think, from our panelists today. So that's why I'm on the panel. That's why I'm moderating this. We're always keen on partners, and if anybody in the room is eager to have more of a discussion with me about what our foundation is doing, very happy to do that. But over to the rest of the panel. So I'm just going to introduce each panelist one by one and ask them a kickoff question, and then we'll have a little bit of a discussion between the panelists, and then we'll open up to you for some questions before we close. So our first panelist is actually a partner in this Bangladesh program. Madhur Jain is the CEO and founder of Varaha Ag, which is a organization that brings technologies and innovative solutions together to access carbon credits. We hear a lot about the carbon markets as a potential incentivization mechanism for these kinds and reward mechanism for these kinds of transitions. And at the same time, as an organization focused on smallholder agriculture, we know there's a lot of barriers to getting these markets to work in emerging markets and smallholder farms. So, Madhur, what are you doing? What are you bringing in terms of your solutions to help bring these carbon credits to smallholder farmers? And then in particular on the financing side, what are you doing to mobilize finance both for your own business, which is a very interesting agtech startup, but then also for the farmers?
Sure. Can we go to slide 7, please? Thank you. Yeah, so just to introduce ourselves, what we do is we help smallholder farmers across smallholder economies as to how to transition to more sustainable practices. So the problem is twofold here. So agriculture contributes to 24% of the total global emissions, which is leading to climate change, but it is also affecting the smallholder farmers the most. Because if you look at South Asia, farmers are dependent upon monsoon rainfalls to grow their production and food. And if these are going to get shifted over a period of time, it's going to affect them the most. So how do you really transition farmers to more sustainable practices and climate agricultural smart practices? I think that is what we are focusing upon. So what we do is we partner with a network of organizations on the ground who have feet on street, and via them we are able to educate farmers, change behavior and practices as to how to do practices such as zero tillage, crop residue incorporation, and then use our science-led tech platform to be able to validate what's exactly going on the ground in terms of behavior change, and then quantifying at a farmer level the emission reduction in terms of methane, nitrous emissions, but also carbon sequestration, which is taking place in the soil. And just to illustrate that this work can be done at scale, it's not like smallholder farmers is tough, there's such small holdings, but we are already working at a scale of close to 600,000 acres in the countries that we work in. And so this can be scaled up if the right experiments, data, products are available out there to build a technological solution on top of it. Just to go to the next slide. And this is where we illustrate what are these different interventions which are stacked together, which are helping smallholders turn their agriculture more sustainable while also making an additional income through it. So we started off with just one problem statement, how to restore soil health, which is regenerative agriculture practices, zero tillage, crop residue incorporation, and the likes of it. But then we saw that these same farmers also have tracts of land which are becoming degraded, and they're not able to make use of it. So we ventured into agroforestry ecosystems along with the same set of farmers and helping them create an alternate income stream in the form of fruits and nuts. Now, we saw organically over a period of time while working with tens of thousands of farmers, India alone is burning 116 million metric ton of residue each year after harvest, which is a health hazard as well, other than hurting the soil in the process. We started to turn that residue into biochar, which again goes back into the ground as a biofertilizer, also locking carbon for hundreds and thousands of years in the process. And then as we started to scale to much, much larger scale, we saw that these same land assets, which are acidic in nature, also needs to be much more pH balanced to be able to increase productivity. So we went into enhanced rock weathering. So we see in urban context that a fintech app is selling insurance, credit, and multiple other products. We've been able to replicate that with carbon, and it's going to scale. So this is a sustainably grown farm from Indian farms. This is biochar. Like, these are simple products, nothing complicated. This is basalt rock powder, which is available in hundreds of millions of tons, which when put into the soil can actually help it turn more productive while also creating a carbon income and providing a climate solution along with it. So these are some of the interventions that Varaha has focused upon across Nepal, Bangladesh, India, and Kenya, and looking to expand and provide benefits to farmers across multiple nations.
Let's move on to our next panelist, because this is just one set of innovations. And what we need in terms of these transformations is not just about rice. It's about all the crops that smallholder farmers can and should be growing on their diversified farms, diversification being a critical component of creating more adaptive and resilient agriculture. Daniela is running the Evergreen Innovation Platform, which is looking at a much larger array of innovations that are coming in from the agtech startup world. Daniela, can you tell us a little bit about what you're doing to broaden this pipeline of innovations that could then be available to smallholders, and what challenges are you facing in terms of mobilizing capital?
Of course, thank you, Simon. So if we could pull up slide 14, please. So at Evergreen Innovation Platform, what we've taken is an approach to help solve the barrier of bringing these technologies at scale to smallholder farmers. Now, the type of challenges, as Hur was mentioning earlier, we're looking at soil health and degradation. Many of these cannot be measured yet. The MRV systems don't exist, and so creating alternative financial income for the farmers for these transitions we're not yet there. And so what we did is we take a pipeline approach to develop, to attract and connect solutions from all over the world that are developing for advanced markets, helping them adapt their solution to the context of a smallholder, and validating that innovation with the farmers. And as we grow, what we're focused on is farmer income, the resilience, the climate resilience, and of course soil health is critical. So the types of solutions we work with are very diverse, but we have a very meticulous process that comes from the innovation world that we see in accelerators. Examples from Y Combinator and many years ago have created that, but aggregating that knowledge and aggregating the access to the farmers and being able to create that feedback loop so that innovations are actually relevant and targeted to the needs of the farmers, and that the farmers will be able to purchase them and continuously utilize them to improve their soil health and improve their income. We're creating this virtuous cycle to really, really strengthen those farmers and taking their resilience and their income into their own hands. So the pipeline approach, and if you can just, there's an animation here, but if you can actually show, it's just a meticulous process, taking us through sourcing phase of understanding what the farmers need. We invest a lot of efforts in working with our farmers to understand their needs, and then sourcing innovations from all over the world. We have innovations today from the UK, Israel, and the US, and of course local innovations from India. And we're always looking for new partners for those innovations. And we take them through a small-scale validation process followed by larger scale and pre-commercial processes, always with one leg with the farmer, one leg working together with those farmers, looking at multiple cropping systems, multiple contexts for the work and for the solutions that we do believe there's relevance, technical relevance to the smallholder farmers. We do a lot of work in helping them adapt their business models, because these are agtech solutions that are financed by venture capital, and they have a completely different risk profile. So we need to help them develop the right business models, help them do that quickly, and help them scale their sales in this market for their investors to be willing to continue to support their endeavors in this smallholder market. One example I'd like to pull up, if we can pull up slide 16, is actually the inspiration behind, and again, if we can ignore the animations, we can pull up the full slide. One of the first technologies we worked with, and this, our Evergreen Innovation Platform was actually a partnership of nonprofits that we spun off into a company. One of the examples was a biological solution, a mycorrhiza technology, which is groundwork bioag. This is a company that tried to enter the Indian market, tried to work with smallholders in a few different contexts and was unsuccessful and therefore left the market. We were able to bring them back, work with them step by step, and India became their second largest market. A very critical component. By the way, one of the things we want to do is look at if we can actually use the income from the carbon as well, now that there's more evidence, so to continuously increase the farmer's income. This is one solution, and we could show very clearly in a variety of crops the increase in the yields, the value, and the return on the investment to the farmers. And this was the use case for our unique business model.
Great, thanks. So moving on, of course, all those startups need financing. They need venture funding in various series of rounds. And Rini Greenfield, very glad to have you with us. Rini's running exactly that kind of a venture fund, looking at what are these best innovations that can be transformative for farmers, both in the US and internationally. Rini, what are some of the most exciting innovations you're seeing, and what barriers are you seeing to capital mobilization?
Well, firstly, this was a great segue. Thank you, Daniela. We're seeing tremendous innovation occurring in agriculture and food systems. Our venture fund invests across all food systems. So we start with agriculture, but we go all the way to food as medicine. And I think Groundworks is a great example of the technology that we're seeing developed. 2% of climate investments go to agriculture. It is woefully underfunded, and there needs to be more innovation funded so it gets out of academia and into Y Combinator and into Rethink Food, and then over back to Daniela. And we're starting to see that happen now. And a lot of that is actually due to the IRA. So hopefully the next 2 years will be an incredible groundswell for agricultural innovation. Oh, thank you, you're at my slide. So what I wanted to actually start with was, Simon, to talk about how food is actually 30% of household greenhouse gas emissions. And I think that's important because if we know that food systems is a third of the greenhouse gas emission problem, and households control 30% of that problem, that means that we can solve the problem through the consumer. And we're seeing this next generation of consumer really drive a change. And this is kind of outside the world of policy and philanthropy. This is the next generation saying, I'm willing to spend 400 basis points more of my wallet share because I'm investing in food that is nutritious and sustainable. And that is ultimately what's going to drive the innovation that we're funding. That was the whole reason that we decided Rethink Food was needed to be created now and invest in these companies today. Can we go to the next slide, please? What we did was identify which subsectors within the food system had the opportunity for the greatest impact. And so here are 6 subsectors, and you can see we talk about how each of them has their kind of quota of greenhouse gas emission that they emit. And it's important. If you look at agriculture, it's 12%, but if you add animal agriculture, it's actually 26%. So it's a massive number. And as venture capitalists, we're investing in opportunities with strong ROI. And to us, these are the opportunities where we see consumers actively driving change, and we're investing in technologies that are data, that are software, that are automation, that are robotics, that are actually creating incredible efficiencies in this system that didn't exist before. So we have fewer inputs and much greater outputs, which ultimately taxes the land much less. So it's a win-win-win. Can we go to the next slide? And an example of this, which hopefully ties into what everybody is talking about, is this company called Planet Forward, which is a portfolio company of my funds. And, what they do incredibly well is that they help companies and brands in particular to be able to measure their greenhouse gas emissions. What had historically cost a company maybe $100,000 a measurement is now down to $1,000 to $2,000. And it is a tool that they're empowered to use themselves, because we went from effectively consulting to software. And the reason they're able to do this is that they took data, the data that existed, they gathered all the data, and then they applied their analytics on top of it so that we could create a complete set of data through AI, through proxy data, enough so that we can take a product, food product, and look at their entire supply chain and say, okay, in a matter of moments, this is the greenhouse gas emission of this product. Consumers want to know this because they're buying according to this. But as the brand, they're able to look at this and say, how do I cost effectively make changes here so I can achieve a lower greenhouse gas emission, or ultimately net zero? And Mycorrhiza will be a big part of the solution because that's part of the supply chain. Viraha is a big part of the solution. That's part of the supply chain. Planet Forward measures all of this for their customers, so they understand what they need and how to get it.
Thank you, Rini. So I think what you're starting to hear from our panelists so far is there are innovations out there on their own, difficult to deploy. We need these kind of interface mechanisms like what Danielle is talking about. And then we need the financiers to step behind them. And those innovations are not just the actual products that farmers are using or producing. They're also the verification systems, the data systems, and advisory services and so on that can then be digitized and offered at very, very low cost, which should enable then scaling to happen. So that is a good on-ramp to our two climate jakes, as I learned they're called. First of all, Jake Cusack with Cross Boundary. Jake, what are you seeing as priorities for the capital raising and capital deployment into this integrated system that we're trying to create?
Yeah, great. And thanks, Simon, and thanks everyone for being here. Great to see a lot of friendly and familiar faces in the audience. So just briefly, Cross Boundary is an investment firm focused on bringing capital in underserved markets. We have 25 offices globally. 22 of them are in emerging markets, and we have both an advisory and a direct investment side to our business. I actually wanted to back out a little bit just to the topic, the overall topic of sort of systems thinking. And if you could pull up slide 20, I think one of the critical things that we believe is that every deal is actually a blended finance deal, meaning that every deal has positive and negative externalities that affect public goods and are not necessarily captured in the core business and financial returns. And because of that, almost every deal already has interactions with public and philanthropic capital now or in the future, or it will have soon. And so when you think about what is in our shared public good interest, our shared future interest, because often the divergence in interest is not a matter of what we believe the effects will be, it's a matter of time horizons. And we seek to lengthen our time horizons and have public goods become more of how we think as individual consumers or as investors. And so we're basically trying to drive things that have positive externalities into the quadrant where they are financially incentivized. And there's two ways to do that. You can do that on a deal-by-deal basis. And so let's take one example. So rural mini-grids, which we invest in Africa, 600 million people in Africa without electricity. Unless we electrify them in a clean, sustainable way, that electrification process alone would cook the planet. So when you think about, what is the right incentives to ensure rural mini-grids happen? Well, you can approach it on a deal-by-deal basis, which is what we've done largely to date. So we've had investors like Rockefeller Foundation, the Family Office, Kenny Arth, Microsoft's Climate Fund, come in with a lower cost of capital because they believe that this public good of clean electrification is worth it. You can also have wider subsidies, such as the World Bank's Nigeria electrification program, where they're providing subsidies across the board to a bunch of different mini-grid investors and developers. And when you think about what IRA has caused, is basically IRA has just opened an avalanche of blended finance deals throughout the US. And so I think if we think in this blended finance frame of what is the public good externalities of any deal we do and how does that create public and philanthropic capital interactions, we will be more responsible and more successful investors. And I think there's also an important personal element to that too, which is if you believe that it is not your company or your business's responsibility to deal with some certain externality, then you must have a policy or philanthropic view on that externality. You can't simply say that I'm going to do my philanthropic activity over here and I'm going to do my business activities over here and I'm going to vote like this. There must be a consistent thread across those because every deal has those elements embedded in them. And just one more slide and then get it over to other climate Jake. So this is a long slide, but I just want to make this point. As we think about blended finance deals, that it's important to be specific. I think when you think about blended finance like 2.0, where we want to go next, to be as specific as possible about the barriers that you're trying to solve. And just to take one example from the slide. So when you think about lack of capital for risk return, and you'll hear people say, we need more catalytic capital, we need more risk-taking capital. Well, what risk are you asking it to take? Is this a pioneer risk? Is this a risk of overcoming a first mover disadvantage? Is this a perceived risk? And then you believe that it will become investable as soon as that perception is overcome? Or is it a structural return risk or a structural return problem? As is often the case in some rural agriculture and rural electrification, subsidy is required to make those deals investable. And I think sometimes the two issues are conflated. First loss capital is becoming a more familiar term. Lots of people ask for first loss capital. First loss capital is only a way to solve a perceived risk problem primarily. It cannot solve a structural issue. It cannot solve a value chain issue. And so if we can be as precise as possible about what barriers we're trying to solve in the system and what the different roles of the public and philanthropic players are, I think we can come up with more intelligent solutions. So I'll leave it there.
Great, thanks, Jake. And I think you're really leading us very strongly into this kind of systems financing thinking and acting as well, because we get a lot of talk about systems financing thinking or systems thinking, but from our perspective, it's about the action on the ground. And one of my slight frustrations is there's been many convenings, many discussions about how we do this climate smart ag shift and shift to regenerative agriculture and so on, and we're still twiddling our thumbs on the frameworks and the discussions and not taking action, and we want to see accelerated action now. So over to Jake Levine, who's the Chief Climate Officer from the U.S. Development Finance Corporation. Jake, how do we drive action in financing? What is DFC doing to enable this action to happen fast?
Thanks, Simon. It's wonderful to be here. Good to see everybody. And I will just say thank you, Jake, for providing the framing and these specific slides. I'm the one person on this panel who did not come with any slides prepared. However, I would like to say that if you could put the last slide that was up back up, because DFC, in fact, commissioned that slide from Cross Boundary. So I will take full advantage of that and maybe use it to help speak to some of these issues. Let me just quickly introduce DFC for those of you who may not be familiar. We're a new development finance institution, the U.S. government's bilateral DFI. We are authorized by the U.S. Congress to invest up to $60 billion around the world. We work only in low-income emerging markets, and we have a mission to crowd in the private sector, to leverage and mobilize private sector finance to drive development outcomes and to drive U.S. foreign policy outcomes. We are building, and we're building off of a foundation of a couple of predecessor agencies, the Overseas Private Investment Corporation, OPIC, and a small development credit authority at USAID. And so far, we are setting high water marks year after year. Last year, we did $9.3 billion of total finance. About 8.8 of that was lending and insurance. The remainder, around $500 million of equity investing into funds and into companies. And a very small bit of that as technical assistance, which I'm going to circle back to. Out of that 9.3, 3.7 billion was climate finance. And my role at DFC is to try to drive that number up, but also to integrate the way that we think about climate into every sector that we invest in. When we think about sort of the food security picture, I think DFC is, on one set of metrics, having success against the goals that we set. We said we were going to do $1 billion of financing for food security by 2025. We hit that goal last year. We think we'll double that by 2026. We've reached 3.9 million smallholder farmers through our projects. But when you think about the scale of the challenge, where we're talking about a total addressable market of 600 million smallholder farmers who are providing 30% of the world's food, we're 100x off of sort of the scale of impact where we want to be. And we know that that also maps onto the gaps in terms of climate finance, where if you think about a few $100 billion of institutional capital going into climate finance around the world, and we have a $1.5 to $3 trillion gap in emerging markets. I had sort of mapped out a few illustrative examples to provide, just to give you a sense of what some of those numbers look like in terms of the kinds of companies and funds that we are working with. I think I will refrain from ticking through all of those in the interest of trying to get to some of the questions around the systems finance. But I'm happy to go into detail about some of the companies and projects. They are exciting, and I think they've sort of touched on some of the notes that we heard on the panel around what entrepreneurs are doing in the way of carbon finance and innovations around precision farming and tech in the farming space. But there was a slide back up that Jake and I worked on together that sort of highlighted a whole host of challenges. And out of those challenges, a DFI like DFC is really only built to manage a couple of them. And they're in this category of, lack of capital for risk return, firm or transaction level constraints. And I think we've often thought about institutional players like DFC and the MDBs in this very narrow band. One of the things that we're trying to work on institutionally, and I said I would circle back to TA, is how do we expand our remit out of that traditional narrow band and a little bit more upstream. DFC has put together two sort of organizational projects that are seeking to do this. One is, in addition to all of our sector lines, we've launched something that we're calling the Office of Catalytic Investments, OCI. And the other is, in my office, a group that we're calling the Upstream Climate Finance Pipeline Development Team. And both of these groups are meant to not only sort of be willing to put the thumb on the scale in terms of risk on a deal, but also to move upstream in the creation of a deal and the formation of a deal, so that when you consider challenges like poor enabling environment or nascent or non-existent industry, where a bank is not typically going to come in and help with a regulatory matter that a country is dealing with, or it's not going to come in and invest as a VC would on developing technology, that you can actually start to bring some of the resources of a government, which is working with not only DFC, but we can access resources. I'm looking at my friend Dan Kamen in the audience, resources from someone like USAID to help think about the regulatory or enabling environment. And there's a whole host of examples of this type of work that needs to improve to create sort of connections and alliances within organizations that can build on each other's competitive advantages. And I think everybody needs to sort of enlarge their own scope of what they feel they have a remit to take on, so that we can start bridging this gap and get from millions of smallholder farmers to hundreds of millions, from billions of dollars to trillions. We're trying to do that in these two sort of narrow pilot ways, and we'd welcome your feedback and help to try to stand that up.
Great, thanks, Jake. I know that you were probably expecting this session was going to end at 12:30, but with the secretaries speaking beforehand, I understand, and I just want to check with the room organizers that we're running through to 12:45. So I'm seeing nodding at the back, so thank you. So I want to just do a quick lightning round because with the Climate Jake's contributions, we're really getting into this kind of crossover pieces that we see as so necessary, and from our perspective of working very closely with smallholder farmers on the ground, they're often just looking for a loan to be able to buy their inputs and maybe some insurance to make sure that if the rains fail, they can repay the loan without losing their farms. But when we think about the system financing piece, it's not just the microfinance for the farmers. It's not just the startup capital that Varaha needs to expand their business. And it's not just the supply chain finance for the off-takers who are trying to now source these climate-smart products. It's having it all woven together because what we otherwise see is everybody holds back. And they say, well, we can manage the risks of our little piece, but we can't manage the other guy's risks, so we're not going to do the lending or the investing and so on. So I want to just hear from each of our panelists very quickly. What do you need from the other actors on the panel here and other actors in the financial system in order to really package this system financing together? 1 minute each. Madhur.
Can we go to slide 9, please? Yeah. So, see, we are, as Varaha, we are able to bring the climate financing and the carbon credit to the table for the farmers. But what we have experienced so far is that if we have to go to hundreds of millions of smallholder farmers and fast, we need to bring other things to the table as well from other actors. So, for example, interest rates at lower cost for farmers who are transitioning to climate smart practices. Buying the produce that these farmers are producing from their farms at a premium rate. Providing insurance that if they are transitioning to a new practice which they are not aware of and taking a risk, they should be provided insurance at very low premiums so that they are actually able to transition to all of these practices and catalyze at a massive scale. So we are working with a bunch of active actors now across countries, including Syngenta Foundation and Simon's team here, to actually be able to do that across multiple smallholder geographies. The next slide. And then I think just on the gap side, so while we've been successful as a young startup to be able to catalyze different forms of financing, so we have grant financing for building data and experimentation to bring trust into the carbon credits. We've been able to leverage VC capital to be able to build the tech and climate science stack. But if we have to really scale the systems, we need climate financing and in hundreds of millions of dollars to be able to scale all of the POCs that we have done on ground successfully while also creating value for all the stakeholders involved. So I think climate financing is the biggest gap that we see for a company like us. We're already operating at hundreds of thousands of farmers, but to go to millions, this is the gap that we see here. And I think it's great to see Jack Levine and Jack from Cross Boundary talking about those points here. Thanks.
Thanks, Madhur. Daniela, 1 minute.
Yeah, so unsurprisingly, all of our infrastructure is based on collaboration with all of these players. I can't do anything alone. Aggregation and trust within the farmers to be able to have any kind of communication and for them to even consider to use a new technology or a new practice is critical. Then we work with the financiers to be willing to give loans or credits to the entrepreneurs who are providing the new technologies. And again, insurance comes into play. I think my challenge and what I'd like to spend a little bit more time on is how innovations have been addressing this market and who is financing those innovations. Because classically, venture capital in agtech is still proving itself. It's growing. It's been consistently growing, and I truly believe in venture capital in this space, at least for some of the subsectors. But they cannot finance those products coming to smallholder farmers. They don't have the risk appetite, and so what we're trying to do is reduce the risk for those companies, make it possible for an investor to allow their company to take that risk while we take that risk with them. But what we need is less sporadic investment in specific companies that all need to develop their own infrastructure, their own reach, their own access, and allowing intermediaries, basically, players like ourselves, like others that are active in the space, to get a piece of that financing, because we then deploy our resources, our expertise, our farmers, our work in an efficient way in pipeline structure to actually, turn out companies that are then going to be investable, that are then we're going to reduce the pioneer risk, we're going to be systematic in the way that we're bringing them through. So I think, and by the way, the structuring element, that by accident I have a financial background, but most operators in my space do not. And I think that's a unique, because it's a new space, it's uniquely required for people like me to be involved in operations on the ground with the smallholder farmers.
Thanks, Daniela. Rini, what do you need from the rest of the system?
I'm going to be very simple. Jake. We need you to invest in funds that are driving innovation globally, because the innovation that's happening here in the US and in Western Europe and in Singapore and Israel, and it's ultimately going to scale down and scale up so that it applies globally. to the developing world. And that's where we're really going to see the big benefit.
And Jake C, as a kind of system orchestrator in some ways, if I understand Cross Boundaries' role, what do you see as kind of, let's say, the weakest points in this connectivity and what still needs to happen?
Well, I think the key thing is we need to know what people want to do as investors. We need to know what their priorities are, what their risk-return trade-offs are, what their policy and public good thoughts are, in order to put together these blended finance capital stacks. And that actually means that, you come to these, relatively short panels, you think it didn't, maybe move the ball that far forward, but it's actually quite useful to come into a room together, because then you find out what people care about. And you find out that you can put together these things that meet different sets of objectives. And so I would just really encourage people to be, to keep convening, and also to be as public as they can be and transparent about what their risk-return hurdles are, what their policy priorities are, because that makes it much easier to put together this relatively fragmented landscape into investable deals.
Yeah. And Jake Levine, I mean, very, hearty congratulations on reaching your 2025 target in 2023. That's very inspiring. $1 billion is great, but we need, many billions, as you said. And you're also implying you need this action from others. I'm particularly curious, what do you need from this end of the panel, from the innovators, in order to be able to deploy that capital more successfully?
Well, I think actually, in a way, I think I don't have an ask for the innovators, because I think that we've got a tremendous amount of innovation, and we've actually got, when you start to do a landscape analysis of the investment environment, you see that there are funds that are raising for seed stage capital. There are venture funds. I think you've gotten a flavor of that here. Where there's a real gap is on the growth equity side, to put equity into long-term growth at scale, which is sort of a precursor typically to somebody like DFC coming in to get into tens, 20s, hundreds of millions of dollars of scalable debt, which is where we really have our own magic in terms of the way that DFC leverages government capital. The best leverage and mobilization potential that we have is in the use of debt at scale. And that is for a number of technocratic reasons that I won't go into in terms of how the US government calculates its own risk. But there's a bit of a gap between the innovators and the venture capitalists and the companies that can actually absorb that type of capital. And I will say, just to Jake C's point on the value of having risk-return appetite, investment requirements sort of transparently communicated. One thing that you start to see in so many of the markets where we're all working very quickly when you begin crunching the numbers is that we begin to run into two major structural problems. One is the cost of capital, and the other is the cost of hedging local currencies. And there, I think there's another institutional set of players that needs to come into this conversation, whether those are MDBs, central banks, institutional capital allocators who can help to bring down those costs. I'm not exactly sure who they all are. We're starting to see some really interesting models coming out of the G20 in Brazil in terms of some of the work that the IDB is doing to buy down the cost of hedging for currency exchange. And that ends up being a huge barrier for someone like DFC coming in. We just blow through our budget in a way that's totally unsustainable, and then we're just back to square one. So I would say there are a few voices that are missing from this discussion on the growth equity side and on the large-scale multilaterals and banking side.
Thank you. And I just from I'm just taking off my moderator hat and just wearing my participant hat for a moment. I think there's another piece that I'm seeing, and this is coming into the work that we're doing with Glenn Diego's team at Milken Innovation Center, is also people who are experienced in this kind of blended finance space. who can help with the design and the deployment. We did a very interesting lab with Milken on the side of COP28 at Abu Dhabi. There's a paper that's available if anybody wants to approach me or Glenn or Steve from Milken. We're happy to share this paper. It gets into some of this stuff, and we have a series of Milken Fellows that we want to deploy into this designing all of these integrated structures. So that human talent capacity building in this space is another critical need, I think. I'm going to...
So can I
yes,
add,
please,
sorry,
Daniela.
just making this conversational here. One of the other elements that I think IDB does really well and really interesting about the way that they're structured is their IDB Invest and their IDB Lab. And Irena, the CEO, has been here. I think they've been very smart at looking at all the stages, because the challenges that I see in my microcosm, right, a very small element, right, we're looking at innovative technologies being hopefully financed by agtech, and many of them, again, the risk return there doesn't work that well in VC. Only in some elements, in some subsectors it works well. But IDB has created an entity that is the lab that is looking at the smaller scale, that is seeding and understands, and it's interesting I worked with them in a different hat, but it's interesting to see how they, they understand the challenges of every stage because they have players in every stage. And so they understand how innovation ecosystem and the structures and the financing needs to work, and the continuity of financing needs to work for that, for large scale farming, right? Solutions aiming at large scale farming or corporates versus that solutions are looking at smallholders in India, where we have layers and layers of risk piled on when we're looking at innovative technologies, and yet we need them to be extremely resilient. We need to invest in their resiliency
Great.
a lot.
Daniela,
So just
I'm
as an
gonna
example,
cut you off
sorry.
because we need to get some questions here from the audience. I have one question that's come in online already, so I'm going to start with that one, and then we'll take, I think we have about 5 minutes left, so hopefully we'll have time for a couple more questions. The online question is, what about aggregating the benefits that panelists highlighted, i.e. an ag, energy, water, social cost of carbon investment adder to push the big donors and the lenders? Maybe Mara, as a player in that space, you could talk about, what do you see as the potential benefits of this kind of aggregation model? And then maybe Jake C., we can get your perspective on that. And then I want to just have a couple, and please keep your answers short.
Yeah, so see, if we see an average farmer in India, they have a land holding of somewhere around 2 hectares, at least the ones who are working with us. And just with that example and running 4 portfolio of categories of carbon sequestration, which is regen ag, agroforestry, biochar, and enhanced rock weathering, the sequestration potential per hectare is coming out to somewhere around 6 tons. It becomes 12 tons per farmer because they own 2 hectares on an average. And if you look at the blended price of credit across these 4 categories, it comes to around $60. Right, so per farmer, you're basically looking at, just in terms of carbon income, aggregating and benefit of somewhere around $700 per annum. And for a smallholder farmer, that is non-trivial. That's almost 40% increase in net P&L, right? And if you aggregate other parts of it, which is lower cost of interest, lower premiums for insurance, and also a premium on their output, you're looking at doubling their income, which can be massive, transformational, like pulling farmers out of poverty while securing food security for the world. These are the benefits that we are talking about here.
Great.
Thanks.
Jake.
Yeah, I think aggregation is critical both in terms of aggregating so that capital has opportunities that are adequately sized to deploy in, and then also, emerging markets are typically low trust environments, at least historically, and that's why you see a lot of vertical and horizontal integration. That's why family conglomerates are often among the more successful companies. That's why super apps are so successful. And so I do think, it has to, you can't try and do too much, and it has to be within the constraints of the business model, but generally we have seen successful companies playing in multiple parts of the value chain.
Excellent. I think we have a question here and a question here. No question here.
The social cost of carbon was mine.
Oh, that was your question. Okay, all right. You're good. Time for one more question then, at least. We have a gentleman here.
Got it. Hey, thanks all for being here. Cooper Weatherby, Pelion Green Future. Question for Rini and Jake C. about how you think about market entry and when your capital is actually sort of appropriately positioned to take on the kinds of risks that are more purely commercial, and then what the sort of Jake L's of the world can do from the perspective of technical assistance or kind of bearing out the fundamentals of a market to make it investable, and what actually investable means to you with the type of risk return appetite that you have.
And so Rethink Food invests usually around Series A, so we're looking at companies that are past their technology risk, past their science risk, and we'll assume scale risk with them. Because I think these companies generally are creating a new sector that has not ever scaled before. So we have expertise on our team through, the former CEO of Pepsi, the former CEO of Chipotle and Tyson. These are global Fortune 50 CEOs that understand how to scale. So that's really how we approach, picking our time to invest and choosing how to scale. Ultimately, everything that we invest in, though, has to make perfect technical and economical sense. If that technology is not driving down the cost of what it is doing or what we're doing, then it's not a fit for us.
Okay, I'm going to have to wrap up. Thank you all. Just in closing, just one thought that I think wasn't perhaps visible enough given who the participants are here, and there were many, many missing participants. Though we could have a panel with 20 people and we'd still not be covering the system entirely. But making sure we're listening to the farmers, that's got to be at the heart of this. We've got to have the vulnerable smallholder farmers' needs. And I say needs rather than wants, because they know what they want, but they don't necessarily know what they need, because they don't have the models, the predictive models about what's going to change in terms of, crop viability patterns, weather patterns, and so on. So it's a crossing over of their wants and then analytics and diagnostics to really understand what transformation is necessary. That has to be part of this whole system change. You have to start there and then build all of this other superstructure that our excellent panelists have articulated around those needs. So that's what we're trying to do. We welcome more participants. And I'm just going to ask Glenn, before we close, first of all, I'd like to just ask you to give a big round of applause to our wonderful panelists, thank you. And then Glenn, just to talk very briefly about the next session.
The links in the chain of the supply and value chain that we're trying to build here in systems finance, is that we started at the policy level with 2 secretaries from the 5th largest economy and the largest economy in the world, and then drilled down to the level of this. And thank you so much, Simon, and all of you for being here. The next stage is we have some of our fellows here from that are both from the Milken Motsepe Prize that had worked in green economy, green energy, and also in food last year. They'll be joining us along with the fellows that come from the IFC Milken Institute program in Washington, as well as some folks from the Public Finance Asset Managers program in the World Bank, plus the fellows that we train both globally and in Israel, working on these innovative finance to launch SDG finance. So Steve will be moderating that panel, but this idea of bringing together people and projects to get to capital and carve that channel of capital to accelerate sustainable finance and get to the things that we talked about. Dan will be on that panel too, and we builds on the things we did around COP28 UAE, and to talk about this. And Dan will be, and others that'll be on that session will be.
And that's 1 o'clock in which room?
That's 1 o'clock in the Carmelita room.
1 o'clock Carmelita.
So be sure to join us if you can, and we'll continue the discussions even at a more granular level of putting together the co-innovation teams to accelerate.
Excellent.
Thank you.
Thank you, everybody.
Thank you.
Thanks for staying with us.
I want to launch the podcast.